2019 has been the year of uncertainty, driven by ongoing global tensions, fear of recession, as well as geopolitical risks. Having said that, the equity markets and bond markets have had a stellar year, boosted by easing monetary policy by central banks around the world. How should investors position their portfolios going forward? We speak to Citi strategists on their views for 2020. Daryl, the global manufacturing indices have been on a decline since early 2018, largely due to trade tensions. Do you see that as an indicator for a slowing global growth?
It is true that we've seen slower global growth over the last several quarters. And as you say, manufacturing has declined over the last several months in particular. I think this is natural for the late stage of the economic cycle that we're in. But I will make 2 points about this. Number one, we have seen a stabilization of growth recently, and that we will expect slow but positive growth into 2020. GDP growth of, say, 2% for the US and 2.7% for the world as a whole. The second point I'd make is that the sources of growth we're most excited about come from non-manufacturing sources. I think the world is moving to a more service-based economy. So we see trends in innovation and changes in consumer behavior and corporate behavior continuing to drive growth into 2020.
The bull market is entering its 11th year in 2020, the longest running bull market in history. Where do you see some of the opportunities for investors?
It is true it has been a long-running bull market, but bull markets don't die of old age. You need to see some triggers to push markets down, and we don't see that into 2020. I think for the US, though, because it has done well, we are more focused on specific sectors that will continue to grow because of longer-term trends. So we think healthcare, e-commerce, payments will be the areas that we focus on in the US. In terms of broader geographic areas, we're much more positive on China, for example, where growth is bottoming and the consumer remains strong. And we think there are selective opportunities in Europe as well, where valuation is attractive and growth does seem to be bottoming.
Lena, we've seen a lot of the central banks going into easing mode in 2019. What's Citi's house views on the rates going forward?
Central banks are expected to take a cautious approach, with negative rates in Europe and Japan expected to continue for some time. In the US, the Fed has cut rates 3 times in 2019, and they seem to be indicating a pause. Citi's view is that there will be no further rate cuts into 2020, with inflation outlook at 2%, which is the Fed target level.
Lena, global fixed income has had a very strong year in 2019, and yields are at a historical low. For clients looking for more yield, what areas specifically can they focus on?
Global fixed income has had a solid year, and those returns look hard to repeat. Having said that, we think that there are selective opportunities in the US high-quality bond space, because in the US markets, it's one of the few markets left with highest positive interest rates. In that space, for the US investment grade, we like the 5 to 10-year bond belly, where there is the largest relative yield pickup. We also prefer emerging markets over developed markets in the Asian high-yield space, particularly the Chinese property sector. If US and China trade tensions ease, as well as if Chinese policymakers continue to support the economy, we think that will be a positive for both risk assets as well as the Chinese property sector.
Jed, the US dollar has been very resilient in the face of 3 Fed cuts. What do you see for the US dollar going forward, as well as the G10 currencies?
Right, dollar momentum is already starting to wane. But in 2020, there are likely to be 2 drivers directionally for the US dollar. The first is growth differentials between the US and the rest of the world, with evidence that economies like the Eurozone and China are starting to stabilize, versus some downside risks possible to US growth, especially if the US consumer slows. The second is a rebalancing of geopolitical and political risks away from, say, US-China trade tensions, which have partially de-escalated, possible resolution of Brexit, to more US-centric political risks. Here I am talking about Trump impeachment, and heading into a presidential election year. So the combination of these two is potentially a dollar negative. 2020 is going to be a year of elevated uncertainties. Now, given all of this, investors are still likely to seek the shelter of safe haven currencies like the Japanese yen and gold that typically tend to outperform in these types of events.
And what are your thoughts on the Asian and commodity currencies?
I think there will be less pressure on the Chinese renminbi to weaken in 2020. One, because of the partial de-escalation in US-China trade tensions, but also because of expected inflows into Chinese equities and fixed income as a result of an increased weightage of Chinese assets into international benchmarks. Now, some of that sentiment will likely rub off on other Asian emerging market currencies like the Taiwanese dollar, where we are already seeing an investment recovery cycle in play. The Thai baht, because of the strong current account inflows, and the Singapore dollar, which has tended to act as a safe haven of sorts, given the rising tensions in this region. I think it is not entirely clear how the Australian economy is responding to the amount of central bank stimulus that we've already seen, and what happens after the next rate cut, most likely in February 2020, if the economy fails to grow. Similarly for Canada, what happens if the US economy starts to slow further? Will the Bank of Canada stance change from the current sort of resilience that we have seen to one which is quite dovish? But what I would say is that these currencies are likely to be firmer against the dollar, but probably lag the European currencies in any kind of rally against the dollar.
We hope you found these insights useful. For more information, please contact your Citigold relationship manager.